morning, everyone. Now let's go for lesson 2. Lesson 2 is about DuPont Analysis, economic value added, and cost volume profit analysis. We've already done these units in these topics in the classroom, but let us talk about these things in PPT. DuPont Analysis, economic value added, and CVP analysis. DuPont Analysis. DuPont Analysis, also known as DuPont Identity, is a framework for analyzing fundamental performance popularized by the DuPont Corporation. DuPont Analysis is a useful technique used to decompose the different drivers of return on equity. Decomposition of ROE, return on equity, allows investors to focus on the key metrics of financial performance individually to identify strengths and weaknesses. DuPont analysis is a model widely used in the financial ratio analysis to designate the ability of a company to increase its return on equity ratio. The model breaks down ROE into three components: profit margin, asset turnover, and leverage. So profit margin, asset turnover, and equity multiplier or leverage. ROE is equal to what actually ROE is. It is net profit upon total shareholders equity. Now this can be written as profit margin into asset turnover into equity multiplier. So profit margin is net income, means net profit upon net sales. Asset turnover is net sales upon total assets, and equity multiplier is total assets upon total shareholders equity. If you look into these three components of return on equity, let me explain to you why DuPont analysis has become very important. Because it says, like, if the ultimate aim of any company, any firm, is to maximize return on equity. Now, how return of equity can be maximized? It can be maximized by maximizing these three components, which will lead to maximization of return on equity. The first component is profit margin. So if we increase profit margin, if we increase net profit to sales ratio, then definitely there will be an effect on return on equity. Second thing is asset turnover. Asset turnover says how much sales have you made out of 1 rupees asset, 1 rupees total asset. So it points towards the proper utilization of assets. So if you make more sales out of less assets, that will be more beneficial for you, and that will lead to more of return on equity. Now let us look at equity multiplier. It says total asset upon total shareholders equity. It means how many assets have you, what amount of asset have you made out of 1 rupees total shareholders equity. So if you made more assets with 1 rupees more shareholders equity, it will increase your ROE. So ROE, return on equity, is the multiplication of profit margin into asset turnover into equity multiplier. And ROE is, if you look into this equation, ROE is equal to net income upon net sales. Net sales gets cancelled out of net sales into divided by total assets, and then total assets get cancelled from the total assets divided by total shareholders equity, and finally net income upon total shareholders equity is left, which means return on equity. Now DuPont analysis breaks down the return of equity into three major components to determine the impact of each of them: operating efficiency, asset use efficiency, and financial leverage. So if you look at the first one, profit margin, it points towards the operating efficiency. If you operate properly, your profit margin will increase. If you are operating efficiently, your profit margin will increase. Asset use efficiency, if you're making maximum out of your assets, you're using your assets efficiently and you're making more sales out of 1 rupees assets. So total asset turnover is a dimension of asset use efficiency. Then financial leverage, it is total assets upon equity. So how much asset have you made out of 1 rupees investment in equity? Then profit margin, this ratio reflects a company's strength in generating profit from each dollar of sales. Asset turnover, this ratio measures how efficiently a company uses its assets to generate sales. Financial leverage or equity multiplier, this ratio shows the extent to which a company uses debt financing. The greater value of the ratio, the greater the risk and uncertainty of the expected ROE. The goal of DuPont analysis is not to calculate ROE, but to identify factors affecting it. If investors are not as satisfied with the current ROE ratio, management can analyze what problem caused its current value and attempt to solve them. So it makes the life easy for the management to find out what has led to reduction in ROE. It can be profit margin or total asset turnover or equity multiplier. This is again one chart, DuPont analysis. Just look into that. Return on equity is made up of return on asset and asset upon equity. Return on asset again, so it's just a bit complicated. Go for this slide only, don't go for this one then. Next one is DuPont Analysis Merits and Demerits. What are the merits? It is a good tool for basic understanding of what will lead to return on equity. Can be easily linked to compensation schemes, because when return on equity will increase, then compensation will increase. Professionalization of purchase and sales functions. It leads to professionalization of purchase and sales functions. It leads to more of increase in sales and increase in profit, increase in asset rationalization of assets. Then demerits, it is short-term measurement because it is focusing more on profit maximization. Before tax measurement, then based on accounting numbers, so it all suffers from all the shortcomings of accounting. Target setting is difficult. It is very difficult to set target for all three parameters. Not linked to the cost of capital. The cost of capital is completely ignored in this. Not linked to the time value of money. Again, time of value of money is not considered. Not linked to value. Then valuation of the company is also not considered, because according to this DuPont analysis, if you want to increase ROE, then you can increase your equity multiplier and you can increase your ROE. But that is not true always, because when you buy more asset out of debt rather than equity, that leads to a decrease in the value of the decrease in the perceived reputation of the firm, and that may lead to decrease in the market value of the firm. So that is not always true that return on equity will be directly proportional to equity multiplier. So these are the demerits. So now let's go for the next topic, which is economic value addition. An economic value added is a concept used in corporate finance to designate an excess or lack in value created over the cost of invested capital. In other words, it is difference between net operating profit after taxes, NOPAT, and cost of invested or operating capital. The positive value of this performance indicator means that a company managed to cover the cost of the capital and create additional value. Conversely, negative economic value added indicates the value of the invested capital is being destroyed. So economic value added is NOPAT minus invested capital into weighted average cost of capital. Economic value added is equal to NOPAT. NOPAT means net operating profit after taxes minus total assets minus current liabilities into weighted average cost of capital. It is similar. We just have to understand the first one, that EVA is equal to NOPAT minus invested capital into weighted average cost of capital. What is NOPAT? NOPAT, net operating profit after taxes, EBIT into 1 minus tax rate. If EVA is more than 0, project value increases. The enterprise creates a value for owners. If EVA is equal to 0, invested value returns without evaluation. So no increase in the value of the assets. And EVA is less than 0, then there is decline in the value of enterprise. So EVA should be more than 0 so that the valuation of the enterprise always keeps on increasing and value addition always keeps on growing. Now, if you look into this, EVA is NOPAT minus cost of capital. NOPAT is operating profit into 1 minus tax base, and cost of capital is capital into weighted average cost of capital. Operating profit is nothing but sales minus cost. So it's just in flow diagram try to understand the economic value addition. Now, economic value added steps and formats. Steps for calculation of EVA: review the company's financial data, identify the necessary adjustments required to be considered, if any, and determine the company's COC rate for the individual cost of capital rate for the individual sources of capital in the capital structure. So you have to calculate weighted average cost of capital for the firm and calculate the company's net operating profit after tax and calculation of economic value added. Formula for the format used is net sales less operating expenses. You come with EBIT, then EBIT minus taxes comes with NOPAT less capital charges, that is invested capital into cost of capital. You get weighted economic value added. What are the merits of economic value added? EVA is a tool which helps to focus managers' attention on the impact of the decisions in increasing shareholders' wealth. EVA is a good guide for investors, as on the basis of EVA they can decide whether a particular company is worth investing money in or not. EVA can be used as a basis for valuation of goodwill and shares. EVA is a good controlling device in a decentralized enterprise. Management can apply EVA to find out EVA contribution of each decentralized unit or segment of the company. EVA-linked compensation schemes for both operatives and managers can be developed towards protecting rather than improving shareholders' wealth. It is only because economic value addition tries to find out what is the value created by various companies, and on the basis of value creation, it is found out that the shareholders' wealth increases. Now, market value added, this is a different concept I've just added for your information, will not be coming in the examination. NVA is the difference between current market value of the company and the capital employed by it. So, similar to economic value addition, where we were considering NOPAT minus capital employed, here we are considering market value, current market value of the company and capital employed by the company. So suppose the market value of the company, the sum of the market value of the equity and debt is 1 lakh and its economic book value of the capital is 80,000 and the MVA is 20,000. If the market value of the company exceeds its capital employed, MVA is positive. If on the other hand market value of the company is less than its capital employed, MVA is negative. MVA is simply the present value of all the future EVAs. So all the future EVAs, when you discount them to the present value, you will get your market value added. And C is weighted average cost of capital here. Market value added is a calculation that shows the difference between the market value of the company and capital contributed by all investors, both bondholders and shareholders. In other words, it is sum of all the capital claims held against the company plus the market value of the debt and the equity. It is described as market value addition is equal to V minus K, where MVA is a market value added to the firm, V is the market value of the firm, including the value of the firm's equity and debt, and K is the total amount of capital invested in the firm. So whatever value of the firm a company has, the value of the company is, including both equity and debt, you subtract cost of capital, amount of capital out of it, and you get market value added to the firm. MVA is closely related to the concept of economic value added, representing the net present value of a series of EVA values. MVA reflects commitment to shareholder values. So when market price increases, if you market value addition, whatever it is, when you subtract the K out of it, that is cost of capital, then you get the amount of capital invested, then you get the market value added from the value when K is subtracted from the value of the firm, market value of the firm. Anyways, this is not very important and this won't come in the examination. This is not from the examination point of view. It has been included only just to make you understand that EVA is different from MVA. Now let us go for cost volume profit analysis. We have done through this concept in an elaborate manner in the classroom. Cost volume profit analysis is used to determine how changes in costs and volume affect a company's operating income and net income. In performing this analysis, there are several assumptions made, including sales price per unit is constant, variable cost per unit is constant, total fixed costs are constant, everything produced is sold, costs are only affected because activity changes. If the company sells more than one product, they are sold in the same mix. So for sales price per unit will be constant, variable cost per unit will be constant, total fixed cost will be is constant. Everything produced is sold, so nothing is left. Everything whatever we produce, that is sold, and costs are only affected because activity changes. They cannot be only operating part is taken care, and it says like only activity changes, only costs are changed. If the company sells more than one product, they are sold in the same mix. So whatever this make they sell, and whatever in mix they make, they sell in the same mix. We have already discussed with CVP analysis. Let us rewind this by chanting again. Sales minus variable cost is equal to contribution minus fixed cost is equal to EBIT. Sales is number of units sold into selling price per unit. Variable cost is the cost which varies with per unit. And for example, if 1 unit cost is 6 rupees, then 2 unit will be 12 rupees, 3 unit will be 18 rupees. Fixed cost is the cost which does not change per unit, which does not change when the units change. So for example, it is 30,000, so it will remain 30,000 for 1 unit, for 2 unit, 3 unit, unless and until we achieve 100% production. So they will remain the same. Then EBIT is earning before interest and tax. It is also known as operating profit. We already discussed about this chart. If you look into this, we've got in x-axis we have quantity, and in y-axis just hold on for a second. It is in x-axis we have rupees, and in y-axis we have costs and revenues, and in x-axis we have quantity. So this is there. Now if you look into this, the total revenue cost and total cost curve, where they meet, where the total revenue cost and where this total cost, total revenue curve, total revenue line, and where this total cost line, they intersect each other, this point is known as break even. And for example, the company is making having production at actual revenue, then actual sales minus break-even sales is margin of safety. The fixed cost line is always parallel to x-axis, because fixed cost line will not change and they will remain same over the period, over the quantity of production. So that won't change. Now let us discuss about the various concepts. Sales means revenue. It is selling price per unit into a number of units sold. Variable cost, it is a cost which changes per unit. Contribution is sales minus variable cost. Fixed cost is the cost which does not change with per unit, it remains constant, and sales minus variable cost is equal to contribution, and contribution minus fixed cost is earning before interest and tax. Semi-variable cost is a cost which has component of both fixed cost and variable cost. Break-even analysis, it talks about what is break-even point. Break-even point is the point where total cost is equal to total revenue. We can say that break-even analysis, the break-even point is the point is a amount of sales, is a unit of sales at which the earning before interest and tax is zero. So zero earning before interest and tax, where shows that there is a break even and the cost is equal to revenue. Then margin of safety is actual sales minus break-even sales. Margin of safety ratio is margin of safety divided by actual sales into 100%. And PV ratio is a very important part when it comes to numericals. And PV ratios nothing but contribution upon EBIT, contribution upon sales, or change in EBIT upon change in sales. So PV ratio can be calculated either as contribution upon sales or change in EBIT upon change in sales. So these are 9 very important concepts of called cost volume profit analysis. One more very important point, that marginal cost. So marginal cost is the cost of making one additional unit. So whenever you decide, for example, you're making 100 units, and when you start making 101st unit, the cost of the 101st unit will be the marginal cost. So here we come to end of the second unit. I hope you all enjoy the session. Thank you. Bye.